Hello. Yeah, hi, good evening. Extend a warm welcome to all the participants in today's webinar, which is a combined webinar on two of our portfolios, Little Champs and Rising Giants. Both these portfolios in this financial year, have shown significant, recovery, with Rising Giants up around 26% financial year to date, while Little Champs is up about 20%, and both these, well ahead of the index. What is interesting, in this recovery phase is the backdrop of slowdown in economic growth, as well as sharp slowdown in earnings growth across the market. And in this backdrop, given the slowdown in earnings growth and still prevailing lofty valuations across the mid and small cap segment, both these portfolios have shown remarkable resilience over the last couple of months. When the market has been volatile and there's been a broader correction. So to discuss some of these underlying dynamics that are driving the recovery on one hand and adding to the resilience, I'll hand it over to Ashvin Shetty, who's the fund manager for both these portfolios, and he'll discuss in more detail about these underlying dynamics. So over to you, Ashwin.
Yeah. Thanks, Arjun. Good evening, ladies and gentlemen. It's nice to catch up after a while. I think we had the last LCP webinar in July, so it's been some time. So as Arjun said, this is for the first time that we are hosting both LCP and RGP webinar together. There's also a reason for it, which we will discuss later during the presentation. So let me just bring up the PPT. So as Arjun said, the context, the broader Indian corporate earnings growth has been witnessing a sharp slowdown, particularly in the last two quarters. And many of you must be aware that second quarter, most of the companies didn't report a very encouraging set of numbers. So as you can see here, from being consistent double-digit earnings growth. So this is the BSE weighted average weighted by their weights in the BSE 500. It was consistently in the double-digit growth phase for a long period of time. But however, in the last two quarters, we have seen it sliding down. So for the latest quarter, the number has come into mid-single digit. So there is a sharp slowdown in the broader Indian corporate earnings as we see. And we're also seeing for the first time now that consensus estimates, which were always going, this is for the estimates for the FY25 and FY26, which were on the in the upward journey. They're being revised upwards for the first time since the second quarter results started trickling in. We are seeing the downgrades to the FY25 and FY26 BSE 500 earnings. And as we speak today, the consensus is still building in very healthy double-digit growth for FY25, even though the first half has not been very encouraging on an actual basis. And for FY26, in fact, the number built is as high as 16%. So we see that given the trajectory we are seeing since last two quarters, we expect that there could be a downside risk to the BSE 500 consensus numbers. And just to discuss the drivers of this slowdown, we believe that there are two important drivers of this slowdown that we are seeing in the corporate earnings. So first is the whole urban consumption seems to be under the pump. Saurabh and colleague Nandita have written blogs explaining the reason for this, which we believe is that clearly the Indian urban middle class is going through a lot of stress. And that is clearly reflected in the broad slowdown in the consumption categories, right from staples to all the way to the passenger cars. And we believe the reason for this, the stress that the middle class consumption is witnessing is primarily because of the structural reason that there is clearly job loss. As we visit more and more factories during our channel checks, we are clearly seeing that 10 years ago, it used to be occupied by a lot of people, but right now we see that that place has been taken by more and more machines, more and more robots and automations that we see in the factories. And also, I think there is also a potential risk of AI, artificial intelligence, taking away more and more jobs. Secondly, clearly through COVID, I think the Indian economy has been through a cyclical downturn, and that has clearly impacted the middle class savings. And as we speak today, the household savings, which indicates the spending capability or capacity of the consumers, that is the worst that we have seen in almost 50 years. So 4.7% was in mid 1970s. Now we are seeing almost after a gap of 15 years, the household savings are at the lowest level. So clearly there is a stress in the middle class, and that is showing up in the earnings of most of the consumption-oriented Indian corporates. So that is the first reason. And the second reason is the government capex, which again has been driving the earnings of many of the Indian companies for the last couple of years. We are seeing clearly stress over there in the last since the onset of FY25. So if you see the red line, it's actually from April to October. This data is compared from the Comptroller and Auditor General website. The YTD government spend has been down 15% cumulative basis. So clearly this number has come down substantially than what was the levels we saw earlier years. And another worrying factor here is that the net tax revenues of the government is also for the same period, April to October, is flattish YOY. So that also kind of adds to the concerns. And just to extrapolate, so if you have to meet the budgetary allocation for FY25 government spend, so for the remaining 5 months of FY25, the required run rate is as high as 60%. So clearly this slowdown in the government capex has also impacted the earnings of the broader Indian corporate world. So that is the first thing. We think that we're clearly seeing a slowdown in the corporate earnings, and we think that we should it is here to stay for some time for now. However, on the positive note, the LCP portfolio earnings has seen an exact reverse trend actually. And we have been discussing about the stress in the LCP portfolio earnings in our previous webinar. So FY24 was a year to forget for the Natal Champs from earnings perspective. A broad range of reasons, the primarily being that because of the geopolitical issue, because of the rise in the interest rates and so on, many of our export-oriented portfolio companies were facing a lot of stress through starting from the second half of fiscal year FY23 and continuing all the way to FY24. Clearly, we are seeing green shoots over there. So that's the good news. So almost, I would say almost 80-90% of the export-oriented companies that we have in the portfolio, we are seeing the green shoots of revival. We'll discuss it a little bit detail later slides. But the point is that the LCP, in contrast to the broader Indian corporate earnings, the LCP portfolio earnings are on an upswing. In fact, as we saw in second quarter FY25, the weighted average earnings growth for the portfolio is up more than 20%. So we hope to continue this momentum. We expect to continue this momentum. But it's been a while that we saw this kind of earnings growth in the Natal Champs portfolio. So that's the good news. Similar is the case for the Rising Giants portfolio. So honestly speaking, Rising Giants never saw a drawdown in earnings as much as LCP, Natal Champs. It had a very good mix of domestic and export. But the good part is that the earnings in Rising Giants portfolio continues to be very healthy. So this number in second quarter FY25, the weighted average growth in RGP earnings was close to 18%. So good news.
Ashvin, worth highlighting at this juncture that in the September quarter, 70% of listed companies in India saw degrowth in earnings, folks. So given that 70% of listed companies, 70% of BSE 500 companies saw shrinkage, degrowth in earnings, the fact that both LCP and RGP are showing robust around 20-25% growth in earnings is not only heartening, it also suggests that fundamentally our portfolio is significantly better in quality than the broader indices are. Back to you, Ashvin.
Yeah. And just dwelling a little bit deeper into the reasons why we are seeing a good, healthy recovery in the earnings. So one, as I discussed, the export-oriented companies have clearly seen a revival. So one important change that we made in the, so we at one point, particularly in the LCP portfolio, we had very high exposure to export, but that was primarily concentrated in the chemical sector. And as you all must be knowing, chemical sectors have been going through a stress for the last 2.5 years. One important change we made is that we brought in much more diversification within the export exposure in the Natal Champs portfolio, and to some extent even in the RGP portfolio. So that clearly seems to have be paying off. And we expect, because given particularly the low base of the last 2 years, so one important good thing is that we never invested into deep cyclical companies. The problem happened is because there was a lot of inventory which got built into the supply chain during COVID years. And at the end retail level, it was demand was not an issue. However, the channel was destocking given the excess inventory, given the rise in the interest rates. So we believe that the channel destocking seems to be behind for most of the export-oriented companies, and hence now we have started dispatches of the companies have started reflecting the end user demand. So we are expecting this momentum in the export companies to continue. Secondly, we also, over the last 12 to 15 months, we also took some exposure to the rural-oriented companies in the portfolio. That continues to be show very high degree of resilience, and that has also contributed to the portfolio earnings doing well.
Ashwin, just to be clear, the bottom left chart is YOY earnings growth for LCP and RGP portfolios with regards to rural-oriented stocks, right? So that's earnings growth that you're showing in the bottom left chart.
Yeah.
Okay, carry on.
And third is that unlike government capex, where we have very negligible exposure in the portfolio, we do have some exposure to private capex. Private capex, albeit moderating, it continues to be very healthy. So, for example, what we have used as a proxy for private capex is to aggregate the total capex done by the BSE 500 companies for the first half of this year. We see that that is still clocking a very healthy pace. So it is up almost 15% YOY, unlike the government capex, which is actually down 15 or more than that during the same period. So this also helps. So we have slightly more exposure to private capex, very negligible exposure to the government capex. So that is also contributing to the relative resilience of the LCP and RGP portfolio companies. And finally, we also like to give some credit to ourselves. So as you must be knowing that we have made a lot of portfolio changes for the last 15 months, and we have been communicating this in our webinars. So for example, in the LCP portfolio, there is a net addition of 8 stocks. In the RGP portfolio, it is even more, at 12 stocks. And we have deliberately and consciously got more and more themes, or diversified the portfolios across more and more themes over the last 15 months, and that seems to be paying off. I don't have the data to show here, but I think most of the new stocks that we have entered in, particularly in this fiscal year FY25, I think they have done extremely well from a earnings perspective. And obviously it requires a lot of backbreaking efforts, requires a lot of travel, not only to assess during bringing any new portfolio in the stock, but also assessing the earnings potential of the existing portfolio stocks. Includes a lot of travel, and we have put up some pictures over here. But in a summary, the diversification that we brought into the portfolio, the new stocks additions that we brought into the portfolio, that have contributed in not in any small measure to the earnings revival that we have seen in both the LCP and the Rising Giants portfolio. So in summary, we are clearly outperforming. We started to outperform the broader benchmark index in terms of earnings. We expect to continue that momentum for the coming quarters. And one important change or thing we wanted to highlight in this webinar is that we are now aligning Little Champs and Rising Giants portfolio. I think many of you must have seen there is a lot of more and more overlap that is getting built between Little Champs and the Rising Giants portfolio. So as we speak today, almost more than 60% of the stocks between the two portfolios are common. Obviously, from a research perspective, it helps us go deeper If you have a lesser number of stocks, it helps us go deeper and deeper into understanding the company. But practically speaking, I'll come before I hand over to Saurabh for the challenges slide. Practically speaking, what we notice is that there is a lot of valuation excesses which is getting built, particularly if you look at, this is the market cap and the trailing 12 months PE, trailing 12 months PE on the vertical axis and the market cap on the horizontal axis. We saw that there's a lot of valuation excesses that are getting built, particularly in this between $2 billion to $9 billion market cap, as indicated by the trailing 12 months price to earnings multiple. And RG, before we started this alignment a few months back, the core of the RGP portfolio was in this market cap bracket. So RGP market cap, average market cap 12 months back was close to 4 billion. So falling squarely within this market cap range. And hence, one of the reason why RGP were getting more and more smaller market cap companies in the RGP portfolio is because of we are finding more value or more reasonable valuation in the lower market cap companies. And secondly, again, this slide again, we have been talking about this many times. So more and more discovery names you get as you go down the market cap spectrum. Just to recap, this is the entrance to the BSE 500. So what we have done is that we have studied the BSE entrance to the BSE 500 over the last 20 years, and we found that one of the best return generating set of stocks in the Indian corporate is the stocks which are on their way to enter the BSE 500. So this is data not for 1 year, 2 years, for the 20 years flat, and you'll find that these companies generate enormous return while they are entering the BSE 500. And as you must be logically deducing, many of these stocks are basically in this bracket, basically particularly less than $1 billion. So that was also incentive for bringing the RGP market cap down, that we can able to catch more and more potential discovery names. So we'll share more details about this when we conclude the exercise, maybe in the next webinar. But this is one clearly we are aligning the LCP and the RGP portfolios. Another incentive was this challenger construct. Saurabh, you want to talk about this?
Yeah, folks, so if you've read Behold the Leviathan, right, what we have said in Behold the Leviathan, what we've said in our blogs over the last couple of years is, if you look at data for corporate India, and by data for corporate India, I'm not just referring to listed companies, even if you include unlisted companies, and we went and found a data set of the 40,000 most profitable companies in India, listed and unlisted. What the data shows very clearly now is that the fastest profit growth in India isn't in the largest 800, 900 companies. It's actually in the 6,000 companies below the top 800, 900. So if you call the top 800, 900 companies, let's call them rulers, right? That's in the right hand side table, it's the rulers, and in the left hand side chart, it's decile 1. Decile 1, the light blue line is the rulers, and these are the largest companies here. PAT typically for the rulers, PAT is above 500 crores. So assume, say, a 30 times PE multiple on that PAT. You're looking at companies with of market cap of $2, $3, $4, $5 billion, large companies. That's not where the fastest growth in India is. The fastest growth is the 5,000 companies who sit below the rulers, right? So the challengers, as we call it in the right-hand side table, the challengers are companies with PAT between 50 to 500 crores, right? PAT between 50 to 500 crores are the challengers. In the left-hand side, in the diagram, in the left-hand side chart, that's decile 2. Decile 2, the second decile of companies are growing the fastest in India. And we realize that disproportionately these companies are below $1 billion in market cap. So three benefits of loading up on companies below $1 billion. Ashwin's already shown you that valuation multiples are much lower below $1 billion than it is above, say, $2-3 billion market cap. So below $1 billion market cap, your valuation multiples are lower. Secondly, profit growth across the country, listed or unlisted companies, below 500 crores PAT, below 500 crores PAT, profit growth is faster than it is above 500 crores. So the smaller companies are growing PAT much quicker. And the third piece is the whole discovery effect, right? We've spoken about since we launched Little Champs. When the market discovers the challenger, when the challenger becomes the ruler. So pre-inclusion, the market doesn't know about it. Post-inclusion, the market gets to know about it. There's discovery of the challenger, and the challenger starts going through the market cap bucket. So think about, if you using the chart on the left, the challenger starts at that less than $1 billion bar, and then the challenger travels up the bars towards the 3, 4, 5 billion, $6 billion mark. So you get the valuation re-rating, but at the point of entry, you're getting faster PAT growth for lower lower PE valuations. And we thought that we want to benefit from that, not just in LCP, but also in RGP. And hence the coming together hence the increasing overlap between LCP and RGP. The goal is to help RGP clients also benefit from our research efforts, wherein we are being able to go out, travel extensively. It is backbreaking travel. Ashvin is a little younger than me, so he needs fewer painkillers to do this sort of travel. But I enjoy it, and as Ashvin said, over the last 15 months, the travel, the diversification of the portfolio, the widening out of the portfolio is bearing fruit. We're being able to find good companies, new companies, whose profit growth is holding up, whose valuations are more reasonable, and the benefits of that you can see clearly in this economic slowdown. In this economic slowdown, where corporate earnings are conking off for the broader market, LCP, RGP earnings growth is holding up. Naturally, if earnings growth is holding up, you're seeing the portfolio outperform. We all live and learn. We learned from our mistakes of 2022, early 23. We learned from those mistakes, and over the last 15 months, we've worked hard to make sure we don't repeat the same mistakes. We've figured out a new way of running these portfolios, and hopefully, as we go into 2025 and 26. This new way of identifying companies, traveling extensively to do on-the-ground research, will bear fruit for you. Running more diversified portfolios with a bigger discovery element, hopefully will bear fruit for you in 2025 as well. Back to you, Ashwin.
Yeah, thanks, sir. And talking about the return performance, I think a better chart to show the LCP return performance would be this. So clearly, again, you talked about this. So clearly, three distinct phases in LCP. It is now more than 5 years old portfolio. We launched it in late August 2019. So clearly, the first 3 years were spectacular. We were compounding more than 30% consistently in the portfolio. And this is where actually, Saurabh talked about the learnings and mistakes. So clearly, I think the set of stocks that we owned during this period, they didn't perform whether from a return perspective or from an earnings perspective. We studied that, the reason for that, and as we talked about, clearly we brought in a set of diversification in the portfolio, new set of stocks and so on. And that result seems to be paying off, more importantly from the earnings perspective, but also reflected in the return perspective as we see. So for the first 8 months of this fiscal year, the absolute return also looks good, and even the relative comparison with the BSE 500 also looks good. So we expect, and our endeavor is to continue on this momentum both on the earnings front as well as on the returns front. Similarly, is the case of Rising Giants. The only difference is that Rising Giants, unfortunately, was launched during this phase when the set of stocks that we invested in didn't do well. So it didn't had the benefit of the LCP, which LCP saw during the first 3 years. But here also the story is the same. We are seeing a very strong recovery in the earnings and recovery in the portfolio returns. This fiscal year has been very good for RGP. Particularly, and we expect again here to continue the momentum.
And folks, in Rising Giants, I have to take the responsibility and say it was my fault. I shouldn't have signed off on launching it in December 21, early months of 22. Rising Giants, remember, didn't see earnings regrowth. Rising Giants earnings grew consistently. In Rising Giants' case, we launched that portfolio right at the top of the valuation cycle, the COVID bubble in high quality stocks. We launched the Rising Giants portfolio in December 21, Jan 22, exactly when these valuations were at a peak. And as the phase one piece highlights, those valuations came off. Even though earnings held up, those valuations came off, and you suffered as clients. I shouldn't have launched it. With the benefit of hindsight, I can see I was wrong in launching it at that juncture. But hey, our job is to learn from those mistakes, move on, and make money for those who have invested with us. And in the last 8 months, the earnings outperformance, and as a result, the share price outperformance is coming through.
Yeah, and I think it's appropriate at this juncture to thank the clients who have stayed the course in the portfolio, stayed the course to the drawdowns. So really thankful for them. And finally, the outlook is that, again, continue to focus very heavily on the portfolio earnings. So as I said, the export demand, we are seeing a lot of green shoots in the export demand. Continue to monitor it closely, company by company. Secondly, new additions, again, we have seen very good hit rate among the new addition in terms of earnings growth. Also, what should also help the portfolio is that the last 2 years, we discussed the earnings growth has not been spectacular, particularly for the LCP portfolio. So there's a lot of pent-up demand, which we think, and these companies, they never stopped investing in the business. So that also gave us a conviction to remain with some of the companies, despite we were seeing the declining earnings. But these companies were doing the right things from a long-term perspective. In fact, as we have discussed in our earlier webinars, we saw, in fact, the highest investments by many of our portfolio companies through these tough years. So as the demand comes back, as things stabilize, I think the investment which these companies have done in the last 2 years, that should also benefit immensely these companies' earnings. And we do have some companies which we continue to hold. So again, we have discussed this before. Alkyl Amines is present in both the retail channels as well as the Rising Ends portfolio. So Alkyl Amines, we continue, even though we have cut down the position, we continue to have it in the portfolio. We are seeing things improving. So obviously the cut in the realization as well as the volumes in the acetonitrile as COVID normalized, as China dumped a lot of acetonitrile. It clearly impacted the acetonitrile volumes as well as profitability. It contributed 1/3 of Alkyl's total revenues and earnings. That seems to be stabilizing now. We are seeing that the import of acetonitrile is stabilizing. It is not increasing at the pace which we saw through last year. Similarly, the pricing, though at the low level, it is not deteriorating. It is stabilizing at the low level. And the other two important products of alkyl amines, that is methylamines and ethylamines, they continue to do well. So we are also seeing, for example, second quarter results of alkyl amines, we are seeing margins bouncing back to 18, 19, which had come down to 14% as low as 14% last year. We are seeing the margins recovering, and also the earnings, which saw a very healthy earnings growth, albeit on a low base of last year second quarter. But nevertheless, we are seeing the earnings recovery in alkyl amines. So we continue to hold alkyl amines with reduced position sizing. An important positive catalyst could be they have found an anti-dumping application against the acetonitrile dumping from China. If there is any positive ruling in favor of alkyl amines, I think we should see very, very fast, much better than what we are expecting, the earnings recovery. Second is Tarsans. This is part of the LCP portfolio. Tarsans, again, same story as alkyl amines. It did very well during COVID, but as COVID cases abated, so did the demand for Tarsans products. We also saw a lot of, because everybody thought that COVID will last longer than what it actually did. So there's a lot of inventory built of Tarsans products in the supply chain. So it took a while for that inventory to get corrected. But here also we are seeing, both in the domestic and more importantly in the export market, we are seeing good recovery as we see in the last 2 quarters of Tarsans. The company has invested big time in a new plant, which will also, besides giving the capacity, will also give it capability to get into very important products like PCR, cell culture, etc., which are currently imported into India. So we believe that next 2 years, Tarsans should see a good revival in the earnings, and hence we continue to hold the position. So we'll stop here. We can open the floor for questions.
Right. Thank you, Ashvin and Saurabh, for that detailed explanation. So to all the participants, if you wish to ask a question, kindly, type down your question in the Q&A box, and we'll take them up. So we already have a bunch of questions. So let me pick up some of the more, some of the questions that are related to, recent, factors. So I'll club a few of these together. So Ashwin, given the recent slowdown that we are experiencing, how are we approaching position sizing? What are we doing to sort of address this issue? And of course, the related aspect would be to do with the high cash allocation. Or high cash position that we're sitting on at the moment. And one participant has asked, why are we not investing the entire sum in money market short-term debts? Only a small part is invested there. So if you could just answer a couple of these aspects.
Yeah, so regarding earnings, obviously we are keeping a very close eye on the earnings of all of our portfolio stocks. Continue to do channel checks, meet the management, assess their earnings, how they likely to do on the earnings front. One good thing is that the portfolio is pretty diversified, and as we talked about, I think that gives us a bit of comfort. Secondly, as we talked about, slowdown is mainly right now restricted to domestic companies, and fortunately for us, we have a sizable exposure to exports. Also, rural stocks, which seems to be holding up very, very nicely. So from a relative perspective, we think that we are better placed from a earnings perspective. Having said that, we continue to keep a very, very close eye on the earnings perspective. Second question was on the cash side. So cash is, I think in the LCP portfolio, it is close to 15%. Similar is the number to the RG portfolio. One of the objectives of holding the cash is also to have a dry powder. So we are seeing a lot of volatility in the share prices in the last few months. And whenever we see an opportunity, so we have a set of stocks. So we have invested, for example, 25 stocks in LCP, 25 stocks in RGP, but our coverage universe is much wider. And for many of these coverage stocks, they are not in the part of the portfolio because right now they are not meeting our IRR or the valuation threshold. But in this market volatility, whenever we are seeing that the share price is seeing drawdown, and it's a good company, but we are purely excluded it from the portfolio because of valuation reason, and because of this drawdown in the share price, it is coming within our valuation comfort zone. I think we are lapping on it, and hence that also having cash at that point in time also serves it better. Regarding feedback on having cash in cash form versus liquid form, take that feedback. Right now, I think only 1/3 of that cash is allocated in liquid funds. We will assess that actually whether we can increase it to say 50% or so. But I think it's a valuable feedback. We'll take.
It's a good point, Ashvin, that we should ask compliance as to what the rules are. If rules allow us to hold a larger form in liquid MFs, it's good input. Thank you.
Right. So another related aspect to this, in terms of how we've been, managing the portfolio, has to do with the churn, right? So the churn has been on the higher side. While obviously, the typical questions are around the fact that, because of the tax churn, because of the portfolio churn, tax implications are, quite significant, whereas, that's not reflected on the returns. I mean, I'm guessing the participant is referring to the overall long-term returns, but that's one aspect of it. But I think I think the more important aspect of this is to do with the churn with regards to certain stocks where we may have exited a bit too early. And the question really is around the factors that we take into account while exiting stocks, let's say such as Vijaya Diagnostics or Home First, where clearly we cited a valuation, concern. But then, since then the stocks have gone up further. So the question is, how do you differentiate between valuation of a company that's overpriced versus, say, egregiously overpriced? And should a company that's just overpriced deserve to be sold on that basis? So that's one part of it. And again, if I can just add a couple of other stocks which have been clubbed into this question of churn and early exit. RHI Magnesita is one of those, along with one more, I think. Yeah, so I guess broadly, if you can cover these.
Yeah. So basically, I think the churn in the portfolio or trimming, I think trimming or exit at this moment is primarily, broadly speaking, on two reasons. One is where the valuation, we think that the stock has reached a level where holding it, say, will not generate the internal rate of return threshold that we see. For example, if it is not able to generate over the next 2 to 3 years 15%, 14%, even that number, I think we typically trim it aggressively or get out of that position. So that has been the reason for most of the stock trimming or exits in the recent past. Vijaya, for example, we bought, I remember in the Little Champs
I
portfolio
think
around
it's worth starting with home first, because that's perfection itself. So Ashwin exited home first, Ashwin, a year ago.
Yeah. So we exited the Home First a year ago. So clearly at that point in time, the price to book multiple, for example, of Home First, which we had written also, was almost similar to, I think Bajaj Finance, the best in the NBFC space. It was, I think, four or even
and a year in,
four
Home
times.
First ka share price wahi hai. So
Wahi
it was
hai.
a great exit by Ashwin.
Yeah.
He figured out it's overvalued. He exited it. Ek saal baad, Home First is trading at exactly the same price. So had we held on to Home First, folks, you would have made 0% return, right? So now I would wish Ashwin gets every stock right like this. Right? I wish every stock was like Home First. Ashwin exits and the stock flatlines or goes down, but he's a human being. So are all of us. And I think the Vijay exit, where we exited, our concern was valuation. Yeah, on every which metric, it looked very expensive to us. I remember, folks, one of the reasons RG got beaten up, one of the reasons RG got beaten up in 2022 was those were super companies. Vijay is an outstanding franchise, but the RG companies was really expensive in 2022. And even though earnings held up, we suffered a drawdown because the valuation multiples pulled back. Our concern was that Vijay would go through something similar. And we sold an outstanding franchise after much debate internally on valuations. I think Vijay has gone up substantially since then. And whilst you would all like to get every exit right, in the scheme of things, we're likely to have some Home First type exits where we press the exit button and the stock then goes nowhere. Home First is back to where it was. But for every Home First, there are likely to be some Vijayas where I think, Ashwin, we sold at what, 800, 850?
Around 650.
We sold at 650.
But
and
Vijay also, we entered at around 350 to 400.
So
we made a good
I'm not disputing. I don't think anybody's now disputing that you made money on it. I think we made a lot of money on Vijaya, just that it rocketed and we got uncomfortable with valuations. But discretion is the better part of valor. We are in an economic slowdown. We are in a very frothy market. There is far too much retail money in this market. There's far too much exuberance in the Indian market. And our job is to be cautious here. We are trying to identify very good franchises. If we can get them cheap, great. We'll then ride with them. If they get really expensive, and that's what's happening, right? In many cases, as was happening back in 2019, 2020, I remember, Marcellus would buy, and in 6 months, the stock would go up 80%. It's happening again, right? Once again, Marcellus is buying and the stock is roaring up. So the stock roars up within 7-8 months of us buying. We naturally have to be circumspect, especially if fundamentals are not rising by 70-80% in 7 months. And hence we are cutting those positions or getting out entirely. We want to do more exits like Home First, where we sell a great franchise and it flatlines thereafter. Perhaps even it comes down, in which case we'll re-enter. But there are Vijayas out there where we make a lot of money on a stock, and then yet it just we sell it thinking it's expensive. and then it rips through. But such is life. To the extent we're able to redeployed the Vijaya money. We redeployed the Vijaya money in other franchises which have also gone up. You're no worse off.
Yeah, and there will be obviously cases like RHI also. The business may not be as strong as what our initial thesis was. So one good thing is that we keep on just don't invest and forget about the companies. We continue to do deeper work into the companies, and if we find that the business model is not as robust or the external environment has changed substantially from the time we invested. So we may get out of the company. RHS is an example of that. We overestimated the benefits or synergies that came from the Dalmia acquisition. It didn't pan out as we had thought. And in case of, unfortunately, in the case of refractories, China again came the refractories. We saw a lot of imports from China, which didn't happen at the same level historically. We saw a lot of refractory imports from China that also impacted RHI. So we'll have some, some cases like RHI, but I would say in most of the cases where we exit or trim, it will be more on the valuation, where we have made a good amount of money.
Great. Thanks, Ashwin, for those explanations. So I think you mentioned one of the drivers of recovery in earnings being exports. So several participants are asking about the risk to the export growth with regards to the policies of the Trump administration. Is there any impact on the policy, on those policies, on any of these portfolios? For these companies' businesses? That's one part of it. And I'll add another question related to geopolitics in terms of, or let's say global, in terms of China's dominance in the automotive industry, right? Rising dominance of China. Does it have any negative impact, let's say, with regards to something like an RSCL Gear Tech? Yeah, these two questions on global aspects.
So on the export side, one mitigation which have built in the recent time is that, again, as I said, like exports, traditionally, we used to have a very high concentration of chemical, so on. We have fairly diversified our export baskets. So we don't have any overtly exposure to one particular sector. Secondly, I think if Mr. Trump, I think he levies taxes on China, I think it will only be so well for the export portfolio companies, the export companies that we have in the portfolio. So I believe that he will be more stricter on China than India. So I think that will do well for the Indian exporters. And thirdly, the companies that we have invested in the exports, so they are the lowest cost manufacturers of the products, basically. So I think, again, don't see that competitive advantage going away. I think even with some duties, I think there is still a lot of cost arbitrage that the exporters that we invested in versus local manufacturing. So we don't see as a risk. However, having said that, it's not that we are ignorant about it. We will continue to see what the president does as he assumes office. We'll keep a close watch, but there are some mitigations that we have in the export portfolio. And regarding the automotive, we have actually very, very limited exposure to automotive ancillary right now in the portfolio. So this is just one company, RACL, that we have right now in the Little Champs portfolio, which is in the auto ancillary. However, RACL is a very niche company. So it supplies very high precision gears to the likes of KTM, to the likes of BMW, Motorrad, ZF. And this is not mass standardized bearings, so it's very high tech engineering gears. The volumes are, because it's a niche, it's a very high value, low volume parts where China is not really present. Actually, it's a very niche high tech gears that is manufacturing. There is really no competition, so they have very high share of businesses with their clients. And in fact, their main competition is from the local players in, say, Europe. And there's clearly there is a tailwind. Right now, the only issue here is that there is no competitive issue. Right now, the issue in RAC is regarding the overall European automotive industry is going through a lot of demand slowdown, particularly one of its key client, KTM, is going through a bit of a challenge that is impacting RACL's earnings, but it's not from the market share or competitive perspective. So just to, in a summary, there is very limited exposure to or competition of the Chinese automotive components or industry right now in the portfolio.
Right. Fair enough. One question on, some of the recent, entrants into the portfolio, and a few questions on particularly one of those, which is Escorts, where people are asking that it fits the description of a large cap rather than a small cap. Does it really belong in the LCP portfolio? And if you can answer that, and then and also share some color on Escorts as a company and what has changed.
Yeah. So we only talked about RGP be going down, but there will also be, because we are aligning, there may be some very good, interesting, good companies evaluated very good valuation in RGP portfolio, which we will replicate in the LCP portfolio as well. So Escorts being an example. The reason for investing in Escort is one we think is that again, as we talked about, there's a pretty bit of resilience in the rural economy. We think that that will continue for a while. Escorts being a tractor company, we see that directly benefiting of that. Tractor cycle has been going through a down cycle in the last 12-15 months. And when you look at the long-term history of tractor industry, these cycles, they do reverse. And rural economy being holding up well, we think that our tractor cycle, we're already seeing in the last 2 months, the tractor volumes which were in the negative zone, they started turning positive. We think that one is that a cycle for tractors will look good going ahead. Secondly, Escorts is a different company than what it was 5 years back. One important change being the change in the parentage. So there's one of the world's largest tractor company called Kubota is now the parent of Escorts. With Kubota coming in, we see a lot of benefits for Escorts. One is the Kubota's technology. Particularly, Escorts has been historically been very strong in the North Indian markets, the wheat markets, heavy tractors. Kubota worldwide is a champion of paddy field tractors. So Escorts really, if it is able to get the technology and really customize it for the Indian markets in a right way, it's a lot of opportunity for it to gain market share in the South Indian market, which is essentially paddy market. Secondly, Kubota coming in also opens the door for Escorts from an exports perspective. Kubota has a very strong leadership in small tractors in US, for example. It has strong presence in Japan and so on. And with India becoming more and more competitive from a cost perspective globally, and also proving its mettle in the engineering side of things, we think that exports is something to look out for Escorts as we go ahead in the next few years. And thirdly, when we compare Escorts margin with the likes of Sonalika, with the likes of Mahindra, there's a lot of delta. So as company continues to scale up its volumes, as it continues to improve its processes and all, we see there is a improvement in margin that can also kick in. And it's available at a, given the tractor cycle has been down, it's also available at a very reasonable valuation. So combination of all these things, as a result, we bought Escorts in the Little Gems portfolio as well.
Okay, thank you. One question on what Saurabh spoke about in terms of our increasing focus on identifying challenges. So he's asked 2-3 different aspects around this around this idea. One is around the fact that because we focus only on listed companies, and whereas several challengers may be still privately held, so does that not become a limiting factor? And an associated question is, as we go down that market cap curve, have we made any changes to our approach in terms of the entire research process or portfolio construction or the filters that we use?
Yeah, maybe I'll take it up. Maybe Saurabh can add. So obviously on the unlisted side of things, there is very little that we can do. So our space is confined to the listed universe, and whatever we can do best within that space, we'll keep on doing. And regarding the change in the investment approach, so obviously the three pillars on which our investment process is based on is cleanliness, governance, the management quality, and third is the capital allocation. So there is absolutely no dilution whatsoever in following that tenets in our investment process. So only change where we have made is being more cognizant of the valuation, what price we entering, having little bit more, being more patient about the entry points, only bite into the stock if it comes within our valuation threshold and all, and also be little bit being more diversified from a position perspective. So as we speak today, I think there'll be a very rare exception of one or two companies which will be more than 5% allocation in both the LCP and the RGP portfolio. So these are the two. I think getting more diversified, more companies, and being highly cognizant from a valuation perspective is all the change that we have made. But there is absolutely no dilution of the three C's that Marcellus stand for.
And I think Escorts is a good example. No? M&M is the M&M which owns Punjab Tractors, Swaraj Tractors. M&M is the leader in tractors. Escorts is a challenger. Escorts is owned by Kubota now, majority owned by Kubota. I think the world's largest or second largest, Ashvin. Kubota is world's largest or second largest tractor
volumes,
company.
I think it's second largest.
Second largest tractor company. Specifically, Kubota is very strong in rice wala tractors, paddy wala tractors. M&M and Escorts are stronger in wheat wala tractors, stronger in North India. But Escorts is the ruler there. It's the dominant franchise. Kubota is the challenger. M&M is the ruler there. Escorts, Kubota is the challenger. Are we convinced that accounts are in shape? Yes, we are. Governance and accounts are in shape. The Japanese are making sure that governance and accounts are tip-top. Capital allocation, Japanese are remarkably good. Remember, Maruti Suzuki to this day, right? India ka economy opened up in 1991. God knows how many auto companies have come. बहुतों ने कोशिश की है, but Maruti Suzuki remains 45% of the car market. Similarly, Hero and Honda broke up, I think in 2011, right? 2011 or 2012. Honda has gone on to become a formidable force in two-wheelers. The Japanese are world-class in auto, especially when it comes to cost-efficient auto. Cars mein leader, bikes mein on their way to becoming a formidable franchise. And we think they'll repeat the same in tractors. So M&M is the leader, but the challenger is Escorts. Clean accounts, good capital allocation, and we think Escorts has it in it to replicate its strength in the wheat areas with Kubota's technology. If Escorts can bring in equally good tractors for the rice areas and fill up its lineup. Escorts tractors tend to be very good in the premium segment. I think it's called Farm Track. Escorts ka Farm Track tractor is almost known as the Mercedes of tractors. Escorts ka Farm Track tractor is the Mercedes of tractors. What Escorts need is slightly lighter tractors, chota HP ka, and especially for paddy. Remember, paddy mein jo tractor hota hai, slightly lower HP, lighter tractor, and that's where Kubota is world class. It's the leader in the world in that. If the Japanese bring that technology to Escorts, then the company will benefit. Secondly, Kubota has explicitly said that rather than exporting from Japan, rather than exporting from Thailand, its two big export hubs are Thailand and Japan. Kubota is saying India will become the export hub. And they've already announced that they're doing capex of, I think, 3,500 crores, right, Ashwin? 3,500 crore ka cap. More than that. So they're doing several thousand crores of capex. UP mein zameen mili hai to create what will end up being one of India's largest factories. And Escorts will use India as a hub. So you as a shareholder, we as shareholders will benefit from the world's leading tractor company for paddy wala tractors, improved capital allocation, improved governance, world famous Japanese Kaizen, cost efficiency. So no compromise in the way we research firms. But yes, a change, learning from the mistakes of 2021 and change in both valuation discipline and a change in terms of portfolio diversification. Rather than portfolios of 15, 20 stocks, it's more like portfolios of 25, 30 stocks now. The economic slowdown, I'm pretty sure, will continue for several quarters. As the economic slowdown continues, if the broader market suffers an ongoing earnings slowdown, that also I'm pretty sure about will happen. Broader market may earnings slowdown barqarar rahega. If valuations become cheaper, that's when we'll deploy that dry powder that Ashwin has accumulated. I think बढ़िया time है, बहुत अच्छा लग रहा है मेरे को that economy is slowing down, valuation sanity is returning. Great time for people like us to work even harder to deploy the spare capital that we have and put it to good use, hopefully in 2025.
Right. Given the positive time that Saurabh has, I'll just squeeze in this question. So Shubha Malavia asks, or rather says says I read Behold the Leviathan. Marcellus is mentioned in that. Can we invest in Marcellus someday? Saurabh.
Someday, yeah, but I think not in the foreseeable future. We have a lot of work to do, Shubham. There's plenty to do here. We're glad that with support of the people on this call, we've been able to build a business which makes money, which makes money for our clients, which gives a life and livelihood to 90 families in India. But plenty to do. We need to make more money for you guys. We need to generate better returns to LCP, RGP, CCP shareholders. Global Compounders is rocking. Meritor is rocking. Both portfolios are making best part of 25% net of fees. And GCP and Meritor have set the bar for us. Right? Ashwin and I also want to deliver like GCP and Meritor. And if we keep doing that, I'm very confident that if we keep delivering good returns, we've got back on track in the last 12 months. And if we carry on that path, we will be able to build a bigger business. And hopefully one day that bigger business will be able to bring in shareholders who are not employees. At the moment, it's an employee-owned firm by and large. But one day, perhaps, we'll be able to bring in shareholders who are not employees. But a lot of work to be done before that.
Okay, great. So Ashwin, back to some stocks.
So I'll log out, Arjun.
Yeah, sure.
Thank you, folks. Thank you for your support on LCP and RGP. We're on the job. We know that we made some mistakes in 22. We've figured out those mistakes. We've got it back on track in the last 12 months. And I think I'm really looking forward to 2025 and continuing to outperform for you. Thank you for now.
Thanks, Saurabh. So Ashwin, back to some more stock-specific questions. So you spoke about Alkyl. I think we mentioned in the previous webinar that there may be an anti-dumping duty, that may come in. Is there any update on that?
No. So the last, so we can share the link. So last update is that the hearing is still going on. Right. So obviously the government department will take time. It also will hear all the parties, all the competitors, the Chinese side of the arguments. But the hearing is going on. So there is some progress at least on the case.
Right. The next one is on control print and the sort of the slowdown we spoke about, and the question is around what around the challenges that they may be facing, given the nature of coding and marking industry. Is there any signs of that at all?
No, in fact, the control print numbers, if you look, it's be very divergent. If you look at the numbers about standalone and consolidated, the standalone numbers of control print are doing absolutely fine. The earnings growth for the first half of FY25 has been in mid-teens, which in the context of the slowdown in domestic consumption that we talked about, I think that number looks exceptionally good. However, the problem is that Control Print has invested in few overseas subsidiaries, and it is obviously that business is being built. So there is no top line. However, the expenses are being incurred, etc., which is dragging the consolidated numbers, consolidated EBITDA, consolidated net earnings. And hence, when we look at just the consolidated numbers print, will look very weak. But when you look at from a core business standalone, it will tell a different story. So our thesis here is that the standalone business is very, very formidable. There is only a handful of players. In fact, Control Print is only Indian company of reasonable size that is present in this industry. It is else all dominated by the likes of Videojet, Domino's, and so on, MNC companies. So it's a very, very good space, very, very good space. But we'll have to wait, have to be a little bit patient that the consolidated revenues, subsidiary revenues start coming in, and it more than starts offsetting the expenses that have been incurred to build the business over there.
So there's one question on the addition of Abbott. I think we've perhaps discussed this aspect in one of the earlier webinars, but of course, our main concern was around the poor response from management with Mankind's entry and the impact on Dufferstone market share of Dufferstone. But along with that, I think we were also concerned about some of the sort of products in the pipeline and not sort of being brought into the listed entity and going into some other subsidiaries. So in totality, there were a number of concerns back then. What changed in terms of our sort of change in view, and why did we buy it in Rising Giants?
Yeah. So Abbott, I will admit that it's not we are not bought it with the expectation that it will be a 20% plus compounder, but more like mid-teens compounder, but with very high degree of certainty given its history, etc. It continues to do well. The last quarter was pretty good from our perspective. So fortunately, the competition has been very, very limited to one segment, to Faststone, which is the fertility segment. We are not seeing any new competition for Abbott in any of the other segments. One good thing that Abbott has done is that it has within its various segment, it has expanded its product portfolio. So that also is helping it. Arjun, what did you talk about the second?
Yeah, so we also had concerns around the future product portfolio. Some of the
conflict of interest with the private entity.
Yes.
So here again we had concern because we have a very big unlisted company in India. However, what we have learned now over the last 1.5 to 2 years is that there is a clear demarcation. The unlisted company, the erstwhile Piramal healthcare business, which was acquired. It's more to do with the cardiology part of the business, even oncology, whereas the Abbott listed company is more into the two Faststones, the Vertins of the world, and more of OTC kind of products. So that concerns has got quite a bit elevated over the last few quarters. We are seeing now a clear demarcation between the line of businesses between the two companies.
Right. Moving on, I guess a couple of questions around, say, when we are assessing, the moats of, any particular company, are we taking into account any potential, impact or let's say foreign threats such as, China dumping on chemicals, that's had a, huge impact. Are we taking that into account, the possibility of that happening, into our analysis, and also, how does that translate into our position sizing?
Yeah. Now, particularly with the benefit of hindsight of the last 2 years in place, I think this has become an important part of our research process. So, is China present globally in that product? If it is present, then there is a very high likelihood, given the slowdown in the Chinese local economy, that product may find its place in the global. So that is just to answer your question. Yes, that is an important part of our assessment during the research process. Ideally, we wouldn't like to buy that if the company's moat is very shallow and it's going to get impacted by Chinese dumping, ideally we would not like to have that in the portfolio. If, however, the company has its niche or it's a pretty diversified company, only one part of the business is exposed to Chinese dumping threat, we will consider that company. And second thing is, again, as you said, in some cases, most of our companies, they are into niche businesses, high value, low volume businesses, where Chinese, we don't see, given the pattern that we see with the Chinese present, they are largely present in high volume, standardized, mass production products. If our companies are operating into niche, then I think the chances of Chinese entering is pretty low.
Right. So going back to one of the two sort of stocks that that we've held on for a long time is Tarson's, and the question is around the fact that the management has been committing on certain things for several quarters, but it's not reflected in any outcomes. In fact, the accidental damage to equipment and the insurance claim, I mean, that too came as a surprise. Does that raise any questions around the among the management's sort of honesty?
So no, if there was any questions about the management honesty, honestly, we said stock will not be part of the portfolio. We keep on doing the channel checks around the company, etc. So if there is any red flag, obviously that stock will not be part of the portfolio. In case of Tarson's, we think the reason for their earnings getting plummeted in the last 2-3 years is primarily because of the whole global supply chain of the products that they are accessing inventory and so on, which, as I said earlier, that we are seeing now that normalizing. And that is also, if you remove that equipment damages charges, I think the earnings will look pretty good for the last 2 quarters. And obviously, we'll keep an eye out for the coming results. But right now, we like to believe that those are clearly one-offs. And if you remove that, the underlying earnings are on a very healthy revival path, what we see.
Right. So last 2 questions. Can you just quickly, discuss Astral? Because I think the numbers went through a bit of weakness in the recent past. What is our outlook in the coming quarters?
Yeah, so at the outside, I would say Astral has a very small position in our portfolio. It is right now present only in the Rising Giants portfolio. The main reason the earnings are going through a bit of weaker patch in the last few quarters is because of the fall in the PVC prices. So there is when PVC prices fall, obviously there is an inventory impact because you have to market the inventory. So whenever the prices fall, there is a loss which is incurred. Secondly, in a falling environment, the channel also stocks low because because if you're right now, for example, buying at a high prices and the price continue to fall, it raises the specter that you'll have to sell those stock at a lower prices. Having said that, I think we are seeing some bit of stability in those prices in the recent months. That's a good sign. Secondly, Astral has acquired or entered into a lot of new businesses beyond pipes in the recent last 2-3 years. This has been a long-standing entry, but in the last 2-3 years, they got into paints, they got into sanitary ware, which is taking its own time to scale up. Again, from a 3-year, 5-year perspective, given the track record of the company in acquiring and scaling up the businesses like adhesives, they have done a fairly good job of in adhesives, for example. We continue to maintain that confidence from a 3 to 5 year perspective. But right. It's a small position in the portfolio.
Yeah, yeah. Right. So I'll take the last question now. Specifically, related to the fact that we are assessing opportunities in smaller companies. How much weightage do we give to high insider ownership to ensure alignment of long-term incentives of management with that of shareholders. And I mean, and is the weightage sort of different for, let's say, a small, mid, large cap? How do we view this?
So ideally, yeah, I think it's a valid point. The smaller the companies, the skin in the games, particularly given the lack of institutionalization which we have, at least the promoters should have sufficient skin in the game. That is also reflective of the drive and the motivation of the promoter. I would say 51% at least, ideally we would want to have. And I think most of our portfolio companies will be reflecting that kind of ownership levels. Obviously, there will be some companies which we have bought where there will be private equity, also. But I think that's a valid point. I think I would say it's not a very, very necessary. The business model is very, very strong. The industry is good, etc. We may override that number which I talked about, 51%. But if it is, I think that kind of ownership, it adds to our conviction levels.
Right. Yeah, makes sense. So yeah, I mean, that was the last question, and so thank you all for joining in today and putting in your questions. If you do have any follow-up questions, do write into us at invest@marcellus.in, and we'll be happy to revert to you. So that brings us to a close of this webinar. Have a good evening. Bye bye.
Yeah, thank you all. Happy New Year in advance. Thank you. Thank you.